Hello everyone, welcome back to our USA Gold Weekly Review and Outlook. It was a pretty volatile week again, although much more in range for the gold price. Wednesday was a big day. Gold popped above $12.50 briefly, but did end up giving back those gains and is under a little bit of pressure as well today. But after it's all said and done, basically ending the week where it started right around $12.20. Oil had a little bit better week and actually a much better day today specifically, and I think that's probably part of what is weighing down on gold today. Oil ended the week up about $1.50. The Dow had a good week, up about 2%, gained roughly 500 points after it was all said and done, at least up to this point, pretty flat on the day today. Another volatile day in Shanghai on Thursday. Shanghai was down about 6% in a single day. Pretty big move there. So all in all, kind of a quieter week in the markets, I would say, but nonetheless still one where we saw a lot of movement within the ranges. In terms of top stories, first thing we want to jump in and cover is the recent elevated talk of the Brexit. So Pete, what's going on there?
Yeah, so the UK is going to hold a referendum in June to determine whether they stay or leave the Eurogroup. Very popular London Mayor Boris Johnson came out in favor of an exit this week. That obviously hit the British pound pretty hard and fell. It's currently trading around 139 against the dollar, which is as low as it's been since 2009. Yeah. That also translated into a big jump in gold in terms of British pounds. Currently about £900 to buy an ounce of gold, which again is a multi-year high, about as high as it's been since the summer of 2013.
Yeah. Really looks like a breakout. They're calling it currency crisis British edition, and we're seeing gold behave much as it does in any currency crisis. And so it's an interesting microcosm of the general thesis for gold ownership across the board. But I find the Brexit talk interesting because, number one, it in a lot of ways it came out of nowhere. Not nowhere, but compared to like the Grexit talk a number of years ago where it was ongoing and repetitive and so forth. And so, what are some thoughts that you might have on comparing the Brexit to the Grexit, and how is this maybe a little different?
Well, most notably perhaps is the difference in the size of the two economies. Greece is relatively small and insignificant. That conversation was more centered on the Eurogroup kicking them out, allowing them to bring the drachma back and then devalue it to kind of reinvigorate their economy. In this case, this is going to go to the British voters, and they will decide whether they're getting enough out of being in the Eurogroup or if they have more advantage being out on their own.
And I think that that's interesting because I agree that it comes as more of an indictment of the Eurozone as a whole. Whether, on one hand you're just kicking in a weak economy, but on this hand you're having a leader of the Eurozone and a leading economy and sort of a stalwart in a currency stability notion. And they're saying no to this. And that's a pretty profound statement, I think. And it's going to be definitely something that we're going to want to keep an eye on moving forward. And maybe continuing to that point, but something that you noted, Pete, that I want to bring up now too is the elevated level of talk, we'll call it, about the failing central bank policies. And that's been a huge ramp up this week, where more and more people are talking about than we've really ever seen. So what do you think
a lot of major articles and very renowned voices in the financial industry now talking about what an abject failure. That here we are, 7 years down the road from the biggest financial crisis since the 1930s. They've thrown everything and the kitchen sink at this, and largely to no avail. The very sluggish growth still, not a whiff of inflation really anywhere, so the question now becomes, what do you do next? Well, the big fear here, and I think Japan has kind of already set the stage for this, Europe to some degree, the ECB, is that you do more. You start pulling the plumbing out. You pull the pipes out and throw it at the problem as well. And that seems to be the path we're going. There's wide expectation that the ECB is going to do more at their March meeting. There is expectation that the Bank of Japan is going to do more at the March meeting as well. But I think the reality is that people are noticing the declining efficacy of this policy, and I think the politicians of the world better start developing a plan for some fiscal reforms.
Yeah, I mean, I think the analogy of pushing on a string. It's the problem and the solutions or the mechanisms to try to solve the problem have just diverged so much that they've become or been rendered basically completely ineffective, to the point where we're now having real conversations about helicopter money, which is just insanity. And I mean, it is something that we talked about years ago as being a possibility, that this is where you would go next, because there's no reversing the course. It's too far gone in a lot of ways. And I think it's compelling to see enough people talking about it now to say, well, what can come of this? But better believe it that when we start going the other direction, if that's really where the politicians take us, for example, if they do start to stand up to central bank behavior, that's going to be a hard road to hoe, because the economies have become very dependent on these things.
It's going to be very painful. And, we talked about some of the ministers of parliament in Japan reacting to negative interest rates and saying that it creates a sense of despair. On the surface, and for a lot of people, if helicopter money occurs and there's just dollar injections into people's checking accounts, there will be this perhaps a sense of excitement. But the reality is that is a sign more than anything else that things are really messed up and we're in deep trouble.
Well, it's short-lived euphoria, and that's only going to be euphoric if people spend the money. If people instead just use the money to pay down debt, you're only further exacerbating the problem, and that may very well be the case. So we'll definitely be watching that, obviously, keeping an eye on all of these things. One real quick note, very specific to gold and silver, is the gold-silver ratio is, in terms of the expansion, the value of silver, the number of ounces of silver it takes to buy a single ounce of gold, is approaching the most that it's been ever. It's about a half an ounce away from the most ever. We're looking at 82.5 to 1. Right now, the absolute low in the ratio was 83 to 1 in 2009, so it is a very interesting development, very interesting divergence in gold and silver. I think it's highlighted by the fact that gold truly is the currency of last resort, and the value that you're seeing in gold and the elevation in value that you're seeing in gold that you're not seeing follow with silver is probably a manifestation of that, but certainly makes silver undervalued even in the context. So were it ever to play catch up and improve in that ratio, it could see some good performance for silver. So we'll watch that as well. All of this, especially in the macroeconomic sense, leads us to the Golden Gong of the Week, which we're handing out to Deutsche Bank this week, who wrote or said, "There are rising stresses in the global financial system. In particular, the rising risk of a U.S. corporate default cycle and the risk of a sharp one-off renminbi devaluation due to the sharp increase in China's capital outflows. Buying some gold as insurance is warranted." To you, Deutsche Bank, the Golden Gong. Thank you very much for watching. I'm Jonathan Casares.
I'm Peter Grant.
See you next week.